Welcome to today's Explainer. Today, we're putting a true global heavyweight right under the microscope, Allianz SE. Whether you're actively managing a portfolio yourself or you're just fascinated by the sheer mechanics of a massive multinational financial institution, we're going to dive deep into exactly what makes this insurance and asset management giant tick. And let's just dive right into the massive mystery we need to unpack today. Think about this for a second. You've got professional market analysts out there projecting price targets for Allianz ranging from as low as 325 euros a share all the way up to 684. That is an incredibly wide gap, especially for a mature, established insurance company. It tells us the market is deeply, deeply divided. So let's figure out exactly what's driving that massive discrepancy. To figure that out, here's our roadmap for today. We'll quickly cover the market landscape, dig into their financial fundamentals, and look at their strategic growth engines. After that, we'll tackle the valuation dilemma, check out shareholder returns, and finally, get to the final verdict. All right, part one, the market landscape. Let's set the macro stage here for why this specific company is so incredibly relevant right now. Look, we're navigating a really specific macroeconomic environment right now. Interest rates have finally stabilized after a wild ride, and inflation is cooling off a bit. But geopolitical tensions still sky high. In a volatile market like this, investors are aggressively hunting for two things, yield and quality. And Allianz, they're basically pitching themselves as the ultimate safe harbor. So moving to section 2, strong financial fundamentals. Does the company actually deliver on that big promise of quality? Let's look under the hood. Well, how does 4.5 billion euros sound? That is Allianz's record operating profit for just the first quarter of 2026, a 6.6% jump year over year. And honestly, this wasn't just a lucky quarter. This immense profitability was driven by sheer strength in both of their major pillars, property casualty insurance and asset management. The underlying engine is absolutely humming. Now, the top-line revenue story is a little more nuanced. Recently, analysts actually revised their revenue consensus down from 190 billion to 165 billion euros. I know, on the surface, a downward revision usually sounds like a massive red flag, right? But context is everything. This revision is really just reflecting that broader macroeconomic environment we just talked about. And here is the kicker. Even at this revised 165 billion level, the company is still projecting a staggering 90% annualized growth rate until the end of the year. To put that into perspective, that's a dramatic turnaround from the 0.2% decline the company saw over the previous 5 years. But financial strength isn't just about revenue. It's about stability, right? 221%. That is Allianz's Solvency II Ratio. If you're not super familiar with insurance jargon, just think of this as a giant stress test. A ratio of 221% means they possess a massive capital buffer, way above what regulators actually require. They've got significant firepower stored up to invest or just return to shareholders. And here's the really fascinating part. They aren't getting complacent. Allianz is embarking on a sweeping 1.1 billion euro restructuring program. Step 1 involves the tough decision to cut up to 1,800 jobs in their European call centers. Step 2, handing a lot of those manual tasks straight over to artificial intelligence. And step 3 is the payoff. Analysts expect this aggressive AI-driven modernization to generate a massive 20% return on investment. That tech transformation perfectly sets the stage for Section 3. Let's pivot from their defensive stability to their offensive momentum, their strategic growth engines. While Europe is obviously their historic stronghold, Allianz is strategically shifting its geographic weight. Over in Asia, they're making a massive pivot, dropping $433 million to acquire UOB's asset management arm in Singapore. That is a direct play for the rapidly rising Asian middle class. Over in India, they sold off some legacy stakes to form a brand new reinsurance joint venture with Geo Financial Services, making sure they stay locked into one of the world's fastest growing markets. And finally, in the US, they're investing 1.4 billion euros to buy out minority shareholders in PIMCO, effectively hoarding way more fee income from their absolute most profitable unit. So they've got strong fundamentals, they're cutting costs with AI, and they're expanding in high-growth markets. Which brings us right back to Section 4 and the core mystery of this explainer, the valuation dilemma. If the strategy is so clear, why the massive analysts split? Let's impartially lay out the battlefield here. The bull case, led by Berenberg's 684 euro target, argues the broader market is just vastly undervaluing European insurers. They believe Allianz's strict underwriting discipline and those new tech investments simply aren't priced into the stock yet. But on the flip side, the The bear case, like Jefferies down at €325, focuses on macroeconomic headwinds. They see a softening market in property casualty and argue the underlying earnings momentum just isn't robust enough right now to justify paying a premium. And caught right in the middle of that tug of war is Allianz's current price-to-earnings, or PE ratio, of 14.3. Now, for a company of this immense quality, 14.3 is a very reasonable multiple historically. However, some consider it a bit high by current standards, and that valuation is really only justified if Allianz can actually deliver on that massive revenue growth forecast we discussed earlier. The market is essentially sitting back with its arms crossed, saying, okay, prove it. If the AI investments expand margins and the Asian strategy works, the stock likely moves towards the bulls. If not, the bears take over. But what happens while investors wait to see who wins that tug of war? Let's jump into Section 5, shareholder returns. Let's start with a quick definition of a really vital piece of financial jargon, beta. Allianz has a beta of just 0.05. Put simply, beta measures how much a stock moves in response to the broader market. A beta that low means this stock is virtually non-correlated to broader market swings. When the overall market throws a tantrum and swings wildly, Allianz barely blinks. It is an incredibly powerful defensive characteristic for a portfolio. And while you hold that stable, low-volatility stock, they actually pay you. The company offers an annual dividend of 17.10 euros per share. At current prices, that translates to a very attractive yield of roughly 4%. This is exactly what investors mean when they talk about getting a return on investment, even if the actual share price stays completely flat. It's a fantastic passive income stream while you wait for the whole growth story to play out. But they aren't just giving cash back through dividends. Allianz is currently executing a massive 2.5 billion euro share buyback program, and they are already 75% of the way through it. By stepping into the open market and buying up their own shares, they reduce the total supply. This inherently supports the share price and makes every single remaining share held by you just a little bit more valuable. Okay, we've covered the macro landscape, the fundamentals, the growth strategy, the analyst war, and the shareholder returns. It's time for Section 6. Let's look at the final verdict from our investment source. The source material really distills the entire pitch down to these three core takeaways. Number 1, quality and yield. You're looking at a fortress of a balance sheet combined with an attractive 4% yield and really proactive tech investments. Number 2, growth in motion. This company isn't static. Their pivot to the Asian middle class and their deepening ownership of PIMCO are very clear, identifiable catalysts for future earnings. And number 3, manageable risk. Thanks to that rock-bottom beta we talked about, this is a low-volatility stock that can absolutely serve as an anchor for a portfolio, particularly if you're a bit more risk-averse. And that leads to the definitive conclusion from the original investment pitch we've been analyzing today. The offer explicitly states, Allianz SE remains a buy for those seeking a stable, high-quality compounder in an uncertain world. They acknowledge the market skepticism, and they agree that if revenue targets are missed, the stock will definitely face pressure. But ultimately, they view current valuations as a highly reasonable entry point for a world-class company that's willing to reward you while it transforms. So we bring it back to you. We've seen the impressive profits, the bold AI bets, and the massive global moves. But we've also seen the loud caution flags raised by bearish analysts regarding a softening market. The data is all right there on the table. The big question you have to ask yourself now is this. In an increasingly volatile and uncertain global market, is a defensive, dividend-paying giant like Allianz the anchor your portfolio actually needs? Take some time to think about how these numbers align with your own strategy. Thank you so much for joining me for this explainer, and remember, always keep questioning the consensus.